This video is intended to be for training purposes only and should not be viewed as giving any advice of any kind for the suitability or non-suitability of any type of investment. We should always seek the advice of a qualified financial professional before making any decisions on any investments. Saving for a first home is often a confusing and intimidating process. We often get erroneous or conflicting information on how to go about this. Hopefully this video will help. We will use a few scenarios to help illustrate the process. It is important to understand how the RSP, open or non-registered, and tax-free savings accounts work. Please watch the other video in this section. The first thing we should do is determine what kind of house we can afford based on our income and living situation. It is not advisable to purchase a house that forces us to live outside our means. A mortgage professional will be able to help in this area. It is also important to know what all of our options are when it comes to mortgages. Mortgage agents with some companies are only able to offer their own products and may not be able to offer as many alternatives. It is best to check more than one source. This video does not cover the mortgage process, but the process around saving the down payment. A down payment of 10% or 20% is more desirable and is also cheaper than mortgages with less than 10% as they require default insurance. This default insurance is different than mortgage life insurance, which is essentially creditor insurance. Some mortgage companies or banks often say this creditor insurance is required to get the mortgage. This is usually not the case. Mortgage life insurance is typically expensive and paid to the lender as the beneficiary. It is also underwritten after the person passes away. It is advantageous to talk with a licensed insurance professional for more information before purchasing this product. In this scenario, a couple has consulted with a mortgage professional at their bank and an independent broker as well. They have been advised that they are pre-approved once they have their down payment, assuming their credit, debt, and income don't change. Based on their income, debt, and other factors, it has been determined that they need to save $50,000 for their down payment on their first home. We will look at a few options. In our first scenario, they speak with a bank teller and open a tax-free savings account. They are offered a high-interest account with an interest rate of 2%. They deposit a little over $400 a month or $5,000 into each of their tax-free savings accounts and achieve their goal of $25,000 each in just under 5 years. In our second scenario, our couple consults with several investment professionals and discover they are not limited to savings accounts or high-interest savings accounts in their TFSA or tax-free savings account. They discover they can use a mixture of investments in this platform, and by using a variety of investments, they find they should achieve an average growth rate of about 6% on their investments over the next few years. Again, they deposit a little over $400 a month or $5,000 into each of their tax-free savings accounts, and with this growth, they achieve their goal of $50,000 in about 4 years. In our third scenario, the financial professionals suggest, based on their income, it may be advantageous to use an RSP rather than a tax-free savings account and use the first-time homebuyers plan to achieve their goal. Based on their income, it's determined that deposits to their RSP will generate a tax refund each year. They also use a mixture of investments within their RSP and achieve an average growth rate of about 6% on their savings. However, because they receive a tax refund, they expedite the process. For the purposes of this illustration, we will say they received a $1,250 refund, which they will deposit together with their yearly deposits of $5,000. The next year, they deposited $6,250 into their RSP and receive a tax refund based on that deposit. Their refund is a little larger each year as they continue this process. They achieve their goal of $25,000 each, or $50,000, in under 3 years. The first-time homebuyers plan allows for a withdrawal from the RSP without withholding tax, providing the funds are used for a down payment on a home. It should be noted that funds withdrawn using this program must be repaid to the RSP over the next 15 years. 1/15 of the amount must be redeposited into the RSP each year. If a person elects not to make this deposit each year, 1/15 of the money withdrawn must be added to their taxable income each year that they do not make the deposit. It should be noted that they have deferred tax on the $25,000 over the next 15 years if they elect not to repay their RSP. It should also be noted that this program can be used beyond a first home purchase, providing the purchaser hasn't owned a property in the past 4 years. Additional information is available on the CRA website or from your financial professional.